Now, as we turn to Europe and we look at what's happening within the European theater, we wanted to touch on again and start with the UK, because when you look at the manufacturer stock levels are at record lows, and that's why we talk about the US the last two segments was all about low inventories in the US. What does that mean? But it's not just a US issue. This is a global problem because a lot of all of the developed nations went to an at-time delivery, low asset inventory levels, trying to maximize profit. And that's where we're seeing these again, as things get worse and not better across the supply chain, and as they're going to get a bit more crowded as we head into the holiday months, this is not something that's going to adjust anytime soon. So then when we look at those input shortages, well, this is what's happening. So when we look at input shortages across all of Europe, you're seeing the same thing. So firms citing input supply as factor limiting production is continuing to go up. When you look at EA firms, French firms, European area firms citing equipment as a factor, they are all significantly going up. So again, it's not just the US, it's not just the UK, it's everybody is seeing these pressures. But we're manufacturing new orders are starting to flatline again. You have that backlog to work through, but delivery times, again, not getting any better. So when we look at the Eurozone aggregate and how is that impacting things, well, consumer confidence is negative, still staying right around the same level. Economic confidence dipping a touch from 118 to 117.5. Industrial confidence right in line, 13.5, 13.7. It continues to be services. Service confidence was the survey was for 19. It came in at 16.8. There's still the concern on what is happening at the service side, what is happening to the consumer, and those are some of those pressure points as inflation continues to go up and wages remain under pressure. Again, coming down to real income, Europe is even worse than the US when we look at the real income, where inflation is now really starting to pick up, a lot of pressure down the supply chain, and that's only going to not only hit the US, but also the local consumer there. So CPI core year over year was expected 1.5%, came in at 1.6. Month over month was expected at 0.2, came in at 0.4. CPI estimates year over year was expected 2.7, came in at 3%. So again, you're seeing this steady grind higher. But when you look at manufacturing, expectations were 61.5 on the PMI side, that is. Expectations were 61.5, came in at 61.4. So you're right in line on the manufacturing side, but it's the services that continues to be that overhang. But now when we look at manufacturing PMI, factor in, again, shortages of supplies, delivery times, PPI month over month, expectation was for 1.8, came in at 2.3%. So you're talking about a big miss and trend continuing to go up which again is going to increase prices, is going to push things higher. So PPI year over year, expected 11.1%, came in at 12.1%. So you're seeing this massive growth on inflation, and how much of that is going to get pushed through to the local consumer and how much of it is going to get exported into the market. So, but when we look at Eurozone loans to households, they're still continuing to grind higher. So households are borrowing, but not businesses. So when you look at households starting to borrow a bit more, you have to look at, well, where is inflation? Where's consumption? Where are wages? And that's when you start to see some of these pressure points. And then the loans to businesses coming down. You had a big increase in borrowing, but you're not seeing a huge CapEx spend. So you're starting to see that whittle down and instead transferring more to the household. But when you look at demand for workers, it's continuing to rise. So we're seeing this steady move up. And that's where you're seeing more jobs coming out. But what are the wages? And are we seeing the increase in wages? Because right now, unemployment came in at 7.6%. Right on expectations, but still elevated versus where things were. Previously they were at 7.7%, revised up to 7.8%, came at 7.6%. So you're making some progress, but not a huge amount. So this is telling us that we'll start to see some of that progress, but what is going to be the wage? What is going to be that payment? Because the underlying cost is going up. So how do you make up for that inflation? How do you make up for that to maintain some of this consumption, which is going to be something to watch? As the, again, Eurozone inflation, services contribution, everything is pointing higher. Non-energy goods. So everything is going higher because everyone wants to blame energy. Everyone wants to blame what is happening here. Not that we shouldn't, as crude is, WTI is at 70.54, and we currently have Brent sitting at 73.40. So we're still seeing this massive shift higher. So, but that means that we're just going to continue to see these pressure points on energy, and then look at food and drinks. That's also going higher. So even if we see energy normalize, you're seeing this expansion of that other levels. And we look at PPI, that's, again, just pointing to what's at the tip of the supply chain to come down to the consumer. So then the contributions to the core rate on services, again, going higher. Core rates, non-energy goods. The non-energy goods is where we keep seeing the pressure. So you can say, oh, it's going to go away when crude normalizes or gasoline comes down. It's not. And when you look at the issues in Europe because of that excessive push to energy transition, you're getting massive price increases on natural gas. You're getting massive price increases on electricity, on carbon. So here is when you're looking at it, this isn't going to go away. It's just going to show up in a very different way. So then when we turn to with the internals, so in Germany, the consumer confidence went from negative 0.5 to negative 1.2. As we keep talking about, the pressure in Germany is growing, which it's not that Germany's not going to grow. It's just going to grow less than expected, as you see with confidence missing in the survey. Import price index was expected at 1.2, came in at 2.2. That's not a good thing because, again, those are prices that are going to get passed on. And then year over year was expected at 13.8%, came in at 15. CPI came in right in line with that pressure coming up, but then retail sales month over month was expected at negative 1%, came in at negative 5.1%. Retail sales year over year expected at a positive 3.6%, came in at negative 0.3%. Those are the pressure points when you look at the consumer and services, because German manufacturing PMI was expected at 62.7, came in at 62.6. Manufacturing isn't the issue, it's the services and then the export side, because you are seeing those prices, and that's going to cap and put that pressure on an economy that's reliant on the export market. And still obviously rely on their consumers. So these are going to be other pressure that's going to come, not just with the export side, but also the local consumer. And then this is when we start looking at German inflation. The survey was at 3.4%, actual at 3.4%, but you were back to the same level we were at in 2008. And based on PPI, services, what is coming down the pipeline and what is coming down the supply chain, we will set a new all-time high, a new high above the 2008 highs. And then but Italy remains that bright spot, with industrial sales continuing to push up and actually coming to 2008 levels. So Italy is the bright spot, but on a percentage level, it doesn't make up for the losses in Germany and the fact that France is either right at estimates, just below. Like France is kind of bumping sideways, Italy going up, but Spain is missing badly, and Germany continues to miss as well, which is putting some of that lower confidence in. And then here's looking at German import prices coming through and taking out the highs going back to 2005, which again passes down to the consumer, both internal and external. So then when we look at price pressures, where is the inflation price pressure? So it's everywhere. And that's when we look at Spain, we look at EU harmonized inflation rate for Germany, which is why the Euro area is going to continue to, again, see that push and pull higher, because Germany is an export nation. They export to Asia, the US, but also to the local European Union. So when they export their inflation, as their import prices are going up, so they're going to pass that through. PPI is going up. All of these prices, again, are going to make up and get passed down into the rest of the country, the rest of the continent, really. So then when we look at Spain, total mortgage lending was down versus the previous, which isn't overly surprising. Retail sales missed estimates, was expected at 0.6, came in at 0.1. CPI was expected at 3%, came in at 3.3%. CPI month over month. Last month was negative 0.8, came in at 0.4. And then when you look at PMI manufacturing, came in slightly above, was expected at 59, came in at 59.5. Just like everyone else, the issue is in services, not in manufacturing, which is where we continue to see these overhangs. And then when we look at France, it's no different. Business confidence was expected at 112, came at 110. Manufacturing, right in line, 109, was expected at 109, came in at 110. Same as the previous. Again, not any real difference, but consumer confidence softened a bit, was expected at 100, came in at 99. PPI, last month 1.1, this month 1.3%. PPI year over year, last month 7.5, this month 8.6%. So this is that is showing you where inflation is going. That is where we continue to see the movement as CPI drifted higher again, expected at 0.4, came in at 0.6. CPI year over year, expected at 1.7, came in at 1.9. And then manufacturing PMI expected at 57.3, came in at 57.5, right in line. Services is the overhang, which is the consumer, which is spending, which is wages. These are the things that we have to continue to look at because, again, 57.5 is expansion. We are going to see Europe grow, just not at what expectations are and what the market is assuming, which, again, is going to kind of adjust some of these expectations as we keep seeing some of these numbers get taken down. GDP estimates getting adjusted a bit lower for Q3 and especially for Q4. Which is what OPEC is looking at when you look at what are builds going to do, what are draws going to do, what is shoulder season going to look like, and then into winter season. So these are things that we have to consider. And now that we've covered Europe, we get to shift over into our favorite place, Asia, and talk about some of the things that have come out for China specifically.